welcome to the deep dive. Okay, let's unpack this. Today, we're diving deep into the latest performance of a fascinating company at the heart of medical innovation, Icon Paycar.
Right. They're a huge clinical research organization, a CRO. Basically, they help other companies, pharma, biotech, even government bodies, run the clinical trials needed to bring new treatments forward.
Exactly. Powered by healthcare intelligence, working from molecule to medicine, as they put it, they develop innovations, push emerging therapies, and, ultimately aim to improve patient lives.
And they're massive, headquartered in Dublin, but truly global. What is it now, nearly 40,000 employees?
Yeah, approximately 39,900 as of June 30th, 2025, spread across 95 locations in 55 countries. It's a significant footprint.
Definitely.
So our mission here is to really dig into their Q2 2025 earnings call and press release. We want to understand how they're navigating this, complex clinical development market.
And what their strategies might signal for the future of healthcare. It's a critical piece of the puzzle.
Absolutely. So what's your high-level take to start us off?
Well, what's fascinating here, I think, is that despite all the ongoing volatility you hear about in the clinical development market generally, ICON is reporting some pretty solid progress, in key areas anyway.
Resilience seems to be the word then, even with market headwinds.
Exactly. Their diverse business mix and those deep client relationships seem to buffer them quite a bit. It's not just about one segment doing well.
That makes a lot of sense.
Yeah.
Okay, let's kick things off with the big picture then. Those top-line figures for Q2. What really stood out to you? Anything grab your attention?
Absolutely. So gross business wins, that's the new contracts they surged, came in at $2,966 million.
Wow, that's a big number.
Yeah, it's up 10.6% compared to just Q1 of this year, so strong momentum there. And then Q2 revenue itself was $2,017.4 million.
Okay, and how did that stack up against expectations?
It was actually ahead of expectations and up slightly, 0.8% sequentially from Q1.
Okay, 0.8% sequential increase. But I saw the year-on-year number was down, right? Like 4.8% decrease from Q2 2024.
That's right. And that's where the nuance comes in.
So how should we read that? Glass half full, half empty. What's the real story there?
Well, it's important to understand why it was up sequentially. A big chunk of that boost came from higher pass-through revenue this quarter.
Pass-throughs, right. Can you just quickly remind us what that means?
Sure. Think of it as money ICON collects for services. They subcontract out maybe specific lab tests or payments to external clinical sites. It inflates the top-line revenue number.
It doesn't really add much to their actual profit margin.
Exactly. So while revenue is up sequentially, you need to look a bit deeper. What's really telling, I think, about their efficiency is the adjusted EBITDA.
Right, the earnings before interest, taxes, depreciation, and amortization. How did that look?
It reached $396.0 million, and the margin was 19.6%. That's actually an increase 1.4 percentage points just from Q1.
Okay, so margins are improving despite the pass-throughs weighing things down a bit. How'd they manage that?
Well, they specifically mentioned solid cost control offsetting higher pass-through revenue. Their gross margin improved to 28.3%, up from Q1, and their SG&A costs.
Selling, general, and administrative. The overheads.
Exactly. Those were down by $9 million compared to the same quarter last year. That's a pretty clear sign of, discipline management, good cost control.
Got it. So these efficiencies, this cost control, how did that translate down to the bottom line? Specifically, adjusted earnings per share for investors.
Yeah, good question. For shareholders, the adjusted EPS, that's profit per share, it increased 2% sequentially, reached $3.26.
Okay, $3.26.
Right.
And what about their overall financial health? Debt levels, things like that.
Still looks pretty strong. Their net debt position was about $3.0 billion at the end of June, and the net debt to adjusted EBITDA ratio was 1.9x. That's generally considered quite healthy, indicates a strong balance sheet.
Right. Okay, now let's shift gears slightly. That critical book-to-bill ratio came in at 1.02.
Yep.
So just to explain that for everyone, for every dollar of revenue ICON recognized in the quarter, they book $1.02 in new business. Which sounds positive, right? More coming in than going out.
On the surface, yes. It's definitely a positive indicator. But there's a but.
Okay. What's the catch? The company mentioned it was, quote, negatively impacted by elevated cancellations. Can you elaborate on that?
Yeah, this really speaks to the broader market conditions. Cancellations were up, both compared to Q1 and compared to Q2 last year. Totaled $909 million in the quarter.
$909 million. That's substantial. What's driving that?
Well, the primary driver, according to the company, was one specific cancellation, a very large trial for a next-generation COVID vaccine.
Oh, okay. One big hit.
One big one, yes. But there are broader reasons too. Things like clients doing portfolio rationalization, basically reshuffling their priorities, or sometimes just negative clinical trial results forcing them to stop a project. It's a mix.
And what's the outlook there? Does Icon expect this high level of cancellations to continue?
The CEO basically said they expect largely similar conditions to persist in the market for the second half of the year. So, yes, cancellations probably staying elevated in the near term.
Not ideal.
No, but they do think it might start to normalize, maybe in Q4 or perhaps heading into next year. We'll have to see.
So even with those headwinds from cancellations, what about the new business pipeline? Are opportunities still coming through?
Yeah, that's the other side of the coin. They mention an encouraging level of actionable opportunities in the pipeline, and they feel they've got good momentum in our ability to win across customer segments.
So new projects are still landing, even if others are getting canceled.
Q seems that way. It suggests the underlying demand is still there, even if there's some turbulence.
Okay, that's a good sign. So let's talk strategic positioning. Where is Icon seeing this growth? You mentioned winning across segments, but are there particular areas like, say, biotech versus big pharma?
It's interesting. They said the overall market environment feels pretty much the same, but they have seen a modest uptick in RFPs, requests for proposals, basically new project inquiries,
How much of an uptick?
in the mid-single digit range, so maybe, 4 to 6% increase. And they noted it was probably more in the biotech segment.
Biotech. Okay.
Yeah, and they also mentioned seeing positives in their early phase business and their phase 3 business, so across the development spectrum somewhat.
But this raises an important question, doesn't it? You hear a lot about how biotech funding hasn't fully recovered yet. So how can biotech activity be up for Icon? Feels a bit contradictory.
It does, yeah. And Icon addressed that. They believe there might be a lag effect.
A lag between what? Funding and starting projects.
Exactly. The idea is that capital raised by biotechs in previous funding rounds is perhaps only now translating into actual project awards starting up.
Okay, so the money's been sitting there waiting to be deployed.
Potentially, yes. Or the decision-making process just takes time. And they have some concrete evidence for this. They pointed out that 3 of their top 4 largest awards in Q2 were actually with biotech customers.
3 out of 4. Okay, that's pretty strong evidence supporting that lag theory then.
It certainly suggests there's real activity happening in that segment for them.
So how is Icon winning these deals? Especially if, as you said, the overall environment is still pretty tough, competitive. Are they leaning on existing relationships?
Absolutely. Leveraging those established partnerships is key, particularly with large pharma companies.
Why large pharma specifically?
Well, many big pharma companies are facing loss of exclusivity issues, their blockbuster drugs coming off patent. So they need to invest heavily in late-stage development for new therapies to refill their pipelines.
And that plays right into Icon's strengths with their scale and experience in large, complex trials.
Precisely. Icon aims to get embedded, gain a greater share of their wallet, as they say. They help these big companies find efficiencies across their whole portfolio.
Can you give an example of how that works, how they leverage that scale?
Yeah, they gave a specific example from Q2. 2 of their largest awards came from a mid-sized pharma company, and the relationship expanded specifically because Icon had performed well for a biotech company that this pharma company had acquired.
So good performance on one part of the client's business led to more work elsewhere.
Exactly. It shows how they can build trust and then broaden the relationship. And they're pursuing this portfolio relationship strategy, not just with large pharma, but actively with mid-sized companies too, offering them that broader support.
Okay, that makes sense. Now, here's where I think it gets really interesting. Beyond the financials, let's talk innovation. Where is Icon really pushing the envelope? Any specific therapeutic areas or tech advancements standing out?
Absolutely. This is a key part of their story. One big area is obesity and related metabolic diseases. Huge growth area, obviously.
Definitely. What are they doing there?
They launched something called the Center for Obesity this year. It's essentially a purpose-built network of over 100 clinical trial sites in the U.S.
Okay. Dedicated to obesity trials.
Yes. And they have access to over 10,000 pre-screened potential patients. The idea is to massively streamline starting up these complex trials.
How streamlined are we talking?
They claim it allows for targeted site activation in 30 days or less, which is fast in this world.
Wow. And what makes it so efficient?
A key driver is technology. They said 85% of these sites are operating on the same integrated technology platform,
So everyone's using the same systems.
right? Which improves everything from patient enrollment and recruitment to, crucially, real-time monitoring of the trial data, consistency and speed.
That sounds like a significant operational advantage.
Yeah.
And it's not just obesity, right? You mentioned technology more broadly. AI is everywhere now. Is Icon using it?
Very much so. They have an AI center of excellence that's working directly with their operational teams. They're developing AI-enabled tools to be used across the business.
Okay, like, wait, could you give a tangible example?
Yeah, one concrete example they highlighted was protocol digitization.
Protocol digitization. What does that mean?
So clinical trial protocols are incredibly complex documents outlining everything about the study. This AI agent they've developed can now intelligently read that protocol data, identify all the relevant tests and procedures needed, and then automatically populate that information into the systems needed to actually run the study, especially in the lab setting initially.
Ah, so it automates setting up the study based on the plan.
Exactly. They described it as a tangible example of how we are adopting AI to evolve our offering, and the payoff is significant.
I bet. Reduced setup times.
Significantly reduced study startup times, yes. And potentially improved overall project timelines and, importantly, overall quality by reducing manual data entry errors.
That's a powerful impact from AI right
Big.
there. Okay, so Icon has the strong financial base. They're innovating operationally. How are they using that strength? What about capital deployment? Rewarding shareholders.
Good question. They were active on that front in Q2. They repurchased $250 million worth of their own shares.
Buying back stock. What was the average price?
$146 per share, they said. And importantly, the board also approved a new share repurchase authorization for up to $1 billion.
$1 billion. Okay,
Yeah.
so that signals they plan to continue buying back shares quite actively.
It certainly suggests that. Alongside that, they mentioned they're also evaluating potential acquisition opportunities. M&A is always part of the picture for large CROs.
Right, buying growth or capabilities.
Exactly. And they stressed continued internal investment, too, in things like those technology platforms we just discussed and other services. So a mix of returning capital, potential M&A, and organic investment.
And what about their outlook for the full year? Did they update their guidance based on Q2?
They did. They maintained the midpoint of their adjusted EPS guidance at $13.50 for the year, but they actually revised their full-year revenue guidance upwards.
Oh, by how much?
The new range is $7,850 million to $8,150 million. The midpoint, $8,000 million, is an increase of $50 million compared to their previous guidance.
Okay, higher revenue outlook, but EPS guidance staying the same. How does that work?
Well, remember those pass-through revenues we talked about earlier?
Right, inflates revenue but not profit much.
Exactly. They indicated the revenue guidance increase is largely related to more anticipated pass-through revenue. Since that generally has lower margins, it doesn't really flow through to significantly impact the EPS guidance.
Got it. That makes sense. Now, you mentioned earlier the market is tough, competitive. How are they handling that pressure? Is it impacting pricing?
They acknowledge the competitive environment has, quote, intensified. It's definitely a crowded space.
So how do they compete without just slashing prices and killing their margins?
Their strategy seems to be doubling down on those operational efficiencies we discussed, driven by technology, by better execution. The idea is that this allows them to remain competitive on price, as they put it, without sacrificing too much on margin.
Because their cost base is lower or more efficient than competitors.
Precisely. That ability to manage costs, including reducing those SG&A overheads through things like automation and AI, that becomes a key competitive edge. It gives them room to maneuver on pricing.
Before we wrap up the operational side, one quick point, China. It often comes up. How significant is their presence there?
Yeah, it's relatively small in revenue terms right now, about 3% of their total revenue, they said.
Okay, not huge today.
Not huge today, but they view it strategically. They described as a source of innovation and potentially a longer-term fuel for the business.
Why fuel? What's the opportunity?
It's partly because Chinese biotech companies are increasingly looking outside China for their clinical trials, especially as they aim for global approvals. And they need experienced global CROs like Icon to help them navigate international regulations and markets.
Okay. So it's about capturing that outbound work from Chinese biotechs.
That seems to be a key part of the longer-term opportunity, yes.
Okay, great. So let's try and bring all this together. We've covered financials, new business, strategy, innovation. What does does this all mean? What's the big picture takeaway from Icon's Q2?
Well, I think it paints a picture of a company that's navigating a tricky market pretty effectively. Strong performance despite that volatility we talked about,
Driven by,
driven by, well, those strategic wins, clearly, but also very much by effective cost management, keeping those margins healthy. And crucially, that ongoing innovation push, especially in high growth areas like obesity and using AI to make trials faster and more efficient.
yeah, the AI part really stands out as a potential game changer.
It really does. And if you sort of connect this to the bigger picture, the longer story, I mean, Icon started 35 years ago with just what, 5 people?
Incredible growth.
Incredible, to nearly 40,000 now. It just shows how they've had to constantly adapt to market shifts, embrace technology, and really meet that fundamental, persistent demand for new medicines.
And that underlying demand isn't going away despite market fluctuations.
Absolutely not, especially in areas like cardiometabolic diseases, obesity, diabetes, heart conditions. The need is huge, and that continues to drive significant activity for companies like Icon. It underscores that fundamental driver.
So thinking about that future, and especially the role of AI and efficiency, what's a final thought for our listeners to chew on?
Well, maybe this. As companies like Icon get better and better at harnessing AI, focusing relentlessly on operational efficiency to navigate this competitive landscape, it raises a really important question for you, the listener, to consider.
Okay.
How might these advancements fundamentally reshape not just the pace of clinical trials over the next, say, 5 or 10 years, but maybe even the very nature of how trials are conducted?
Reshape the nature of trials themselves.
Yeah. And what knock-on effects, what implications might that have for how quickly patients actually get access to new novel therapy? It's something we're thinking about.
That is a fascinating question to mull over. How technology doesn't just speed things up, but changes the process itself and ultimately patient access. Great insights. We hope you've enjoyed this deep dive into Icon Contact.
Definitely food for thought there.
Absolutely. We encourage you to reflect on these insights and what they might mean for the future of healthcare. Thanks for joining us.